Hi everybody, it's Chris here from Serene Education. Just going to do a brief update on my weekly analysis for the coming week from Tuesday the 10th to Friday the 14th of February 2014. Okay guys, let's have a look at the euro to start with. Look in the monthly, you'll notice that we had a very bearish start to the new year. January falling back on the month. However, you can see quite clearly at the monthly fib level, price is now trading at the 50% retracement level, and subsequently we've now seen a bit of support coming through on our shorter term time frames. The start of February, if I just drop down to the weekly time frame, you'll notice that we have seen a consolidation at the 50% retracement level. Notice the indicator box primarily still all blue, including the most important one, the monthly time frame. So we know that the overall sentiment for euro against US dollar is one of upside, and you can see where price is trading right now in conjunction to this uptrend. Take away this fake out over here, for example, this tweezer bottom on the prior support and resistance level at 23.6. You'll notice that price is now trading in and around a prior monthly support level, but also the trend line support level. So look for bias to the upside. We do have a red arrow, however we've still got blue candles, and as long as we keep having blue candles, then we know that the sentiment still wants to govern to the bull side. So as it stands at the moment now, very much positive, so therefore we should be looking for further buying opportunities for this week in particular. We have had a consolidation, however a very strong support level on the monthly is clearly in play at the moment. Now we have had lower swings. There we go on the daily. You can quite clearly see that we've had a swing low. However, a lot of momentum coming through last week in particular, and you'll notice that we have a blue arrow and a blue candle now close on Friday after the non-farm payroll out. Not better than they forecasted, slightly bigger than the prior one, but not as great as they expected, and we saw euro gaining a bit of strength on that. And also some positive figures coming out of the ECB press conference earlier in the day. Draghi mentioning a good number of things that really a lot of the makers out there were happy with. So here, look for upside. Ideally we like to get above the prior support and resistance level high, which is roughly around this area, and here you're looking ideally anything above 1370, 90 and change. For all you passive traders would be great, because then we could look in excess, we could look to see if we could target those October highs, December highs, roughly around about 125 pips and change. But as it stands at the moment, as long as we are seeing the 50% monthly retracement here being a strong support level, then we'd like to see a bounce, and ideally look to target, if anything, this current support and resistance level higher, just below the 1379 and change. Anybody looking for passive trades would ideally like to see a trade above this area to capitalize on the long-term support and resistance level high. Here you can see the RMO is still below, and also our SMO indicator on the daily. That is not a good sign. So got to see those moving in our favor to see any opportunities to the upside. 4 hour time frame, I get a buy signal. Everything's clearly looking positive on this time frame. You'll notice that we have a blue arrow, blue candles. The institution moving average was breached, close of play on Friday, and if you want to be very aggressive, then look to see if we can actually target the price of one resistance level here, roughly around the 1369.55 and change. Get above that, then we're looking plain sailing back up towards that 61.8 monthly fib level, roughly around the 1382 and change mark to the upside. Onto sterling. Let's have a look over here. Currently we have, looking at the monthly figure here, you can see that going back to 2009 in particular, I've mentioned this a couple of times, the institution moving average as well as this psychological round number or the monthly fib level has been a clear resistance level in the past, and this goes back to 2009. The institution moving average clearly governing price on the monthly at this particular level here, and you can see that price is trading both between the monthly fib level here at the 38.2, but also the institution moving average. If I just move this line, I've put this horizontal yellow line in here to confirm to me where the institution moving average is on my monthly, on my shorter term time frames. So you can see the institution moving average on the monthly fib clearly right now where price is trading, and you can see that January actually closed lower, but that was also in fundamental news, but also it just goes to show how things actually really apply. The market's clearly falling back at this exact level which we've seen in the past. So now if we clearly see the only thing that's really going to help price maintain these highs is if the monthly fib level actually acts as a support level for this particular price. If we don't see that happening and we see this month closing lower, then what we could ultimately see is price starting to pull back, and ultimately we could look towards our 23.6 fib level on our monthly down here as our long-term goal. And between the 38.2 monthly to the 23 point, you're looking at just over 1,000 pips, so more than enough in the coffers to warrant a nice trade to the downside. However, if you look at the actual indicator box, there's far more positiveness than negativity, and you notice that the R squared is complementing a lot of that positiveness that we're seeing intraday. Long-term sentiment still up for the monthly fib level on this particular pair. So let's go drop down into our weekly time frame just to see how things are panning out. You can notice on the weekly straight away, the past month in fact has showed a lot of indecision. You'll notice all these candles over here with a lot of wicks happening in and around the 38.2 monthly fib level, and this is primarily you're seeing indecision creeping into the market, because if you took all these bodies here, for example, and you put them all into one and you took all the wicks, you'd have a massive spinning top, and the spinning top represents indecision, and that indecision is coming around a major psychological resistance level high, which is our monthly resistance level high, which constitutes to the institution moving average, but also that in 2009 to present resistance level. But we also have a monthly fib level, and it's imperative, if price is still to be positive for sterling, we need to see the institution moving average, the monthly fib level here at the 38.2 acting as a support level for this price. So as long as price consolidates here but positiveness, then there's always going to be a likelihood for price to test the current highs, and that's at 1665.54, that institution moving average monthly high level that we've just come from. So consolidation here for the best part of a full month and going into the first week of February. You'll notice that last week, in fact, we saw a lot of negativity creeping out for sterling, but non-farm payroll didn't really bode well for the end of week figures for the US market, and sterling actually was able to capitalize on that, and we saw a push higher. So the bulls clearly in favor here, but still a very indecisive counter because there's a lot of wick, but most of the momentum happening at the top end. The only downside to this, though, this could actually be one of two candles. It can either be a hammer, but it could also be a negative candle in a hangman. Now the hangman happens around a major support and resistance level high. You can quite clearly see that even though we had price pulling up, it's still happening under the monthly fib level. And a hangman, you want to see a bearish engulfing candle close lower. That will definitely tell you that there's no more highs to be seen. You see a lot of shooting stars. The past 2 weeks, in fact, at the same level. These constitute a lot more selling sentiment at the bottom end of the wick than at the top. So you have the shooting star, and now is this, question mark, because I don't know what it is, I'll be speculating if I had to say that, this hangman. The only thing that's going to actually tell us this, if this is a genuine hangman candle, this last week's candle, is we have a bearish engulfing candle that precedes it. So this week, bearish engulfing, closes lower. That would clearly tell us that this is a psychological high. We're not going to see any further highs, and then we're looking to see price pulling back. But where along this pullback is price likely to go? Well, it could always go back towards the 23.6 level. Not so. I mean, clearly been here over a number of years. In fact, 2011 was a very strong resistance level, support level for price over that period. What you can do is take the current low that we saw in June of last year and draw fib level to the current high. Now you'll notice that the weekly range for sterling, we actually saw price just trading slightly higher above the 22.6 weekly fib. So these red lines over here constitutes my weekly fib. I've got to have a starting point, which is clearly up, and I've got to see a consolidation point. So you clearly know more highs here, and price is consolidative. Now I want to see if price had to break or drop lower, where is it likely to go to? Here, clearly, 23.6 represents not only the near-term support and resistance level highs here through August, October of last year, but also the long-term resistance level highs that we had back in March of 2012 through July, August, September, November of 2012 as well. So here, clearly a genuine target level if we do see negativity raining in on sterling for this coming week. So ideally, long-term, if we get below the 23.6 level here, at the 1621 and change, then ultimately look towards the price support and resistance level, consolidation level here, which happens to be the 38.2 fib weekly level as our second target, and that is roughly around, you're looking at 266. Take away the spread, take away some of it to give you that confirmation candle breakout, you're looking in excess of 200 pips there of clear profit to the downside if and when the candlesticks give us that confirmation. So there's more than enough target areas to the downside if we don't see sterling making new highs anytime soon. So here, clearly indecision. Okay, you take this whole range, we're still very much an indecisive range. Is there any news this week that could actually potentially move price higher or lower? It remains to be seen. However, if we are to see any further positiveness for sterling, we do need to get above the psychological support and resistance level high, which is this current high that we're seeing here, and the all-time high, which is the 1666.54 and change. Have to get above it. The longer we find resistance here, the longer we consolidate here, the more negative sentiment creeps in, because people will start thinking, hold on a moment, I'm not making any true money here, I'm wasting time because price is just going to consolidate. And if price is just consolidating in and they're not making any profit, then they're likely to close their contracts and then walk away, which will then start to flood the market with those contracts, and people start to purchase those selling contracts, and then we'll see price falling drastically to the downside. So heads up, just watch this one very, very tentatively. Last week's bearish engulfing, or last week's hammer, or this over here, this candlestick formation here, could be one or two things. It could be a bullish engulfing, it could be a hammer. Ideally, it would have been far better to be above the 38.2 level to show us this is purely January potential for a construction candle, or this could be a hangman. So here, clearly the head above, his body hanging below, but we need to see a bearish engulfing candle to confirm that, and then we should be looking for negative sentiment for the following week. Moving on to the US dollar Swiss franc, here the monthly, a lot of selling. We've had a nice positive bounce. However, price has been, for the US dollar, has been very, very consolidative against the Swiss franc for almost a year. However, we've seen price breaking lower than this current support level low here, roughly around the 90.51 and change. That's a red line, the horizontal line. And price since then has actually tested the 38.2 monthly fib level low and consolidated there through January to December and January, in fact. And going into February, we're seeing a bit of negativity, so we clearly have some resistance level highs above us. You notice that the indicator box over here is primarily red, and the R squared is complementing that negative sentiment. So that's telling us we should be looking for selling. And if you look at it, the candlesticks are still red. There's no blue candlesticks. So the overall sentiment for the US dollar against the Swiss franc is still very much negative. And we've seen a lot of negativity since 21, in fact. Not one of the candlesticks on my monthly turned blue, so we should have been looking for selling opportunities throughout that same period. Great template, this, very mechanical in its approach, gives you a lot of insight, and if you're a long-term trader, then you would be very much in a lot of profit. Moving on to the weekly time frame, we move down to the weekly. There's my monthly fib levels, and you can see that price since the best part of June, July of last year has been negative. We have seen swing lows, in fact. If I just zoom in so you can see it a lot more, you'll notice that the June highs, you can see nothing but swing lows. And if you are seeing swing lows, that means that price is making lower swings, which means there must be negativity on that, and sure enough, we've seen price edging lower. The candlesticks have been red as well, so telling us we should be looking for negative sentiment even on the pullbacks. And that's subsequently what we are seeing right now in real time. We have seen consolidation, however, over the past month or so, and you'll see that the start of January, we've had a lot of indecision creeping in for the US dollar against the Swiss franc, a lot of ups and downs going sideways. However, if we are to see the positive sentiment that we saw through December, we do need to see the current resistance level high, the swing, prior swing high low, if it makes any sense. The highs are getting lower, which is this one over here, currently at 91.26 and change. We need to see price trading above that. We need to see the candlesticks going blue, and then we need to see the indicators intraday complementing that. And then our first target would be the monthly fib level that we've just come from, which is the 50% retracement level, which is a healthy 225 pips away from where we currently stand. However, we failed to see any new highs going into to the new month. In fact, through February, we don't see new highs being breached. We'll go down to the daily just to show you that. Then ultimately we should be looking for further negativity, and you can see on the daily here, for example, last week in fact we saw a lot of negativity forming a new swing low. So if anything, we should be looking for negativity to reign supreme for the US dollar against the Swiss franc, unless fundamentals out here dictate this week that we should be looking for higher highs. So as it stands at the moment, we have red arrow, red candles, RMO's below, the OSMO's just peaked below on Friday after that negative non-farm payroll figure result. Ideally, we would like to see the current support and resistance level here, which is the 89 90, what's it, the 89.33 and change mark being breached, and then you can actually capitalize quite aggressively to the monthly fib level, which is a healthy 95 pips and change away from that level. So here, patience is a virtue. We've got to get breach below this 89.33 to see any clear selling opportunities for the remainder of this week. The sentiment is there. We should just need to see a confirmed break below that level to really capture the momentum on this downside. Last pair of the day, the US dollar Japanese yen on the monthly. Here you can quite clearly see a lot of fall from greats in 2007. In fact, we saw a nice support resistance level being forged through 2011. Patience is a virtue here. Ultimately, non-farm payroll actually really started to see the move higher here. But subsequently, since then, we've seen price moving higher and testing the monthly fib levels to the upside. But price, as you can quite clearly see, a lot of purchasing or positiveness into the December highs, but that's come unstuck at the 61.8 monthly fib level. And January, you can see quite bearish engulfing. In fact, as a lot of negative news came out for the US market against the yen, and that subsequently now forged this bearish engulfing top or tweezer top, and that at the top end of a major trend high at a resistance level high, the institution moving average high constitutes now to negative sentiment. You'll notice that we still see a lot of positiveness though, guys. So even though we have a negative candlestick set up here, the indication is that the long-term sentiment still wants to drive higher. We do have, if you look at it, the candlesticks that are blue. However, we don't have any arrows to confirm it. The last arrow we actually had was this red one right back here. So now we've got to wait for the blue arrow to confirm. And ideally, a break of 61.8 above the institution, that would then give us the blue arrow, and then we could look to the upside with a lot of confidence. Go down to the weekly time frame, see what price has been doing over this period. You'll notice that for the best part of 2013, in fact, price was trading within a wedge. I just want to make that clear so you guys can see that. A major wedge level here, and then through October, November of last year, we had a nice breakout above the monthly fib. Great opportunity to capitalize on that through most of November into December. However, taking everything off the table when we hit the 61.8, and you can see the massive pullback we've seen since then. Candlesticks are still blue, so we know that the sentiment still wants to genuinely move to the upside. The positive overall positiveness sentiment-wise is still wanting to move higher. However, we have a red arrow, and that red arrow just confirms that we're seeing a pullback, and that pullback is likely to happen because we're trading into a monthly fib level high. Candlesticks are still blue, so we should still look for upside to be governing price. The monthly fib level here, the monthly 50% fib retracement level is still below price, and as long as that's in play and that keeps price above that level, then we're likely to see no red candles, and if we don't see any red candles, then we're not seeing a change in market sentiment, which will then look to the downside. So here, as long as price trades above the monthly fib level, then we should still be looking for opportunities to the upside. However, you'll notice now when I go into the daily, you'll notice we have a red arrow. The candlesticks are red, but we're not trading below the institution moving average. Very, very important. Price will be a lot more negative if it was trading below the institution moving average, and the candlesticks were also ready to confirm that. So very, very important. We do need to get below the institution, we then have to be trading below the monthly fib level. Okay, the 50%. So the price has got to do a lot negative-wise. The US dollar is going to be very, very negative indeed to get us back below those levels. Failure to do so, we should still be looking for the overall sentiment to be favoring highs. We have had swing lows, swing lows, swing lows, swing lows, swing lows, swing low. However, you can see price is consolidative now. So ideally, if we are looking for buying opportunities, we do need to see a blue arrow. The candlestick needs to get blue again, and then we could target the current monthly fib level high that we've just come from. And in order for that to happen, we have to break a price swing low, which would be roughly around the 103.54. Get above that, then we should be seeing price making another valid attempt towards those 61.8 monthly fib level highs at 105.64. Failure to get above that, then we could see price making a new swing low, and then we could see a valid target back towards the monthly fib level, but also our institution moving average down the bottom. Okay guys, that's the four majors in a bit of detail. That's the way I look at it. Put my analysis together over a weekend for the following week. Then I just tie up, if I do need to see price trading above highs or lows, put my trigger alerts in, make sure my money management is still in favor. If and when I get those trigger alerts, then I will then look for an entry, a valid entry, make sure my money management actually adheres to that, and then I'll take the trade. Keeping it very, very mechanical in my approach. no speculation, no governing. Making sure that there's no major news announcements for that particular day. Please be aware of any fundamental news out for the following week when you do your analysis. Very, very important. And make a note of that, whether it be on the charts, on your notes, but be well aware of any major news announcements that are likely to factor in price action on those particular days. Hope you have a fantastic week. Take care, guys. All the best.